Hello, my name's David Miller. I'm the manager of Nexus Global Solutions Portfolio and the co-manager of Dynamic. I'm speaking to you from London. Spring is in the air in early April, but I have to say it's been a tough month for markets. March was not good news for equities. Solutions down about 1.6%, Dynamic down 3.4%. Now that's a lot less than the market, but I don't like to report losing money. I don't like losing money. So I need to lift the veil a bit on what we've been up to give you some evidence about the benefits of management and being engaged with markets at the present time. So, asset allocation, pretty much as it was a month ago. Solutions is well diversified with about 56% in equities, 28% in cash and bonds, and the rest in alternatives. Dynamic, the equity portfolio is 94% equities, 6% in cash. So we're engaged with markets still. We haven't backed away from taking risk. So what's going right and what's going wrong? And that's most important to understand. A lot of things are going right. We've got good economic growth. Company results are satisfactory to good. Inflation is on the up, but not by as much as thought. Interest rates have gone up a little bit, but as predicted. This is all essentially okay and a firm foundation against which to manage money. If you look at the Brexit situation in the UK, in fact, the rhetoric seems to be softening a little bit. Corporate Europe is as interested in a soft Brexit as anyone in the UK. Mutual self-interest usually works. And in fact, the pound has been a bit stronger against both the euro and the dollar in recent weeks. So what's upset markets? Essentially, I think it's down to two things. The first one is around Facebook and the sharing of confidential information that may in due course lead to changes in legislation. But it was a shock and it has knocked the technology sector a bit in recent weeks. So that was point one. And the second one are trade wars. A month ago we were just beginning to hear from the US administration about steel and aluminium. It's gone further than that now. The Chinese have retaliated. All we can hope at this stage is that this is negotiation or negotiating ploys and that in due course compromises will be reached rather than further escalation. But if it does escalate, it's not good news for economic growth. That's where the concerns lie. That's why markets have been volatile and also from the equities side down a bit. But we're not investing in these things. We're investing directly into fixed interest markets and equities and alternatives, making decisions on a case-by-case basis. And here the news is a lot better. In the UK, for example, we've had several takeover bids this last month, and we've had our share of those with Nexus and then also Shire Pharmaceuticals. In Europe, good news from a range of corporates that were invested in good companies producing good profits. Adidas stands out, Kion, again, both of them have gone up in price despite falling markets. And in the US, we have diversification. It's not just about the technology sector, although we have our fair share. Interesting to note that both Netflix and Google went up in price last month, whereas Amazon and Facebook went down. But it's other areas, it's the oil sector, it's the utilities, it's the value in the US market that has come through as investors have rotated between sectors. And then in solutions, which is the diversified portfolio, the gilts that we hold in the bonds section, the longer dated ones have made money, again against a falling market. This has provided stability for the portfolio, and that's exactly why they're there. And then alternatives, a range of hedge funds, private equity, commodities, property, all in aggregate stabilising the portfolio when equity markets were having a bit of a wobble. That's the theory and that's working in practice. So where are we going to go from here as we enter into the second quarter of this year? Obviously very important will be to keep an eye on the numbers. Case by case, statistic by statistic, company by company, it all adds up to a picture of what's really going on in the global economy, what's really going on for companies that we invest in, That's what we're most interested in, rather than the highfalutin theories that come down from economists who only look at the GDP numbers. That's what matters. That's what fund managers like me are supposed to do. We're spending our time watching those numbers and drawing conclusions from it and adjusting the portfolio as we need to as we go through the rest of this year. Thank you very much.